Good afternoon. This is your weekly update with Jim Stewart. I'm the Chief Investment Officer at Worth Asset Management, and today is October 10, 2022. And I'm coming to you from the beautiful and sunny Denver, Colorado. I'm here on conference, but I'm still going to provide you the three threes for the week. I'm going to go over the top three market movers, the top three asset classes, and how we are positioned on the equity and the bonds. So let's jump on in.
Okay, let's go over the top three market movers for the week. We're going to go over the economic data from last Friday, the jobs report, and then this week's PPI and CPI for September, and then also the chart of the week, which is our savings rate. All right, let's talk a little bit about what happened last week. We had OPEC basically come down and cut production of 2 million barrels. That was 1 million more. So crude oil, gas, commodities all surged tremendously for the week. On Friday, we had our jobs report. Our non-farm payrolls for September came in at 263,000 jobs added versus an estimate of 250,000, which I'm going to go over right here. Now, we've talked about this in the past. We see the jobs coming down. Even though it was hotter than expected for September, the bigger issue actually is on the unemployment rate. The labor force participation rate actually went up last month, which was finally a positive. That means more and more workers were finally getting back out in the job force. Well, that went back down. So that was almost like a double whammy that happened. We had a hotter than expected jobs number, and the labor force participation rate came down. That's why we had a sell-off on Friday. All right, let's go over the asset classes for the week and on a year-to-date basis. For the week, we had a really strong beginning to the week across the board. And so even though we had a sell-off towards the end, the week ended up being positive for the majority of things. Our bonds and our real estate ended up on the negative side, but everything else was up about 1% to 2%, with, again, commodities being the big winner because of the OPEC cut. On a year-to-date basis, though, we still have the U.S. dollar and commodities are the winners so far. Our bonds are still down 14 plus, and our equities are negative 20 and up to negative 30. So still a very, very difficult environment. But here's the weekly and the year-to-date outlook. All right, let's go over some of the economic data for this week. We have a lot of corporate earnings this week. We have a lot of financials coming out. We've got Morgan Stanley, we've got Citigroup, we've got BlackRock, JP Morgan. We also have a couple additional companies like Pepsi-Cola, Delta, United Healthcare. So this is kind of the big start of the earnings season this week. So we'll kind of see how the corporations are doing. On Wednesday, we have the producer price index for September, estimated to come in positive 0.2, and a core PPI is estimated at 0.3 month over month. We also have on Wednesday the FOMC meeting note, so we'll get to see what the Fed is thinking. But on Thursday is probably the big market mover, and that's the consumer price index. We've been waiting for this to kind of see what we get, to see if all these raises in interest rates is starting to affect the CPI. Well, right now the estimates are both positive at 0.2, and on the core it's 0.4. So we shall see here in just a second what that means. On Friday, we have retail sales for September. That is also coming in positive. And then we get a look at the consumer with the Michigan consumer sentiment also on Friday. All right. Now here's a funny little picture, but this is kind of how we feel, right? This is kind of what they're reporting in the CPI, and this is the actual inflation that we're feeling. So I thought this was a funny little graph, and I got a kick out of it. I hope you do too. But let's take a look at the numbers. All right, in the top graph here, we have the headline CPI, and on the bottom, we have the core CPI, which is, again, excluding food and energy. Well, we have on the headline have started to come down off its high, and so that is a positive. But what we're seeing right now and what the Fed is seeing is that the core inflation, when you take out that food and energy, is still going up. It is still sticky, and we've got to see that come down. And it's still going to be, it's going to take some more months, probably until 2023, until we start seeing that come down. And then that will finally be a positive on the interest rates that the Fed is raising. All right. But let's go over another graph using the CPI and take a look at how the workers are doing. Well, these two lines, the blue line is the average hourly earnings, where the red line is the CPI. They've been pretty much lockstep for a while, and then COVID hit and they got out of whack here. But over the last 18 months, inflation has just shot up. Well, the hourly earnings has basically plateaued here. And it's very difficult to have the CPI, right, the inflation above earnings. And I'm going to show you why. This leads us into the chart of the week, which is our savings rate. Okay. And so what we have here is it's been trending about 7% over the past 14, 15 years. And then again, COVID came, right? And they started sending out money and checks and stimulus, and everyone's saving rate shot up. Well, then they stopped and we started going back, and then they sent out a couple more stimulus checks. Well, as you can see from this chart, we're at the lowest level of savings rate since 2008. And that is starting to concern some people, because, and here's the question I'd like to ask is, how is the American consumer, how is you and I, how are we still spending despite inflation outpacing our wages for the last 18 months, right? So that's the biggest question that everyone's needing to know and answer, because if I don't start getting, raises, or if everyone out there doesn't start getting raises, they've already depleted their savings. So they're going to then start borrowing money, which, if you remember from a couple videos ago, I went over the borrowing rates, and we're at all-time highs on interest rates for those. So it's a catch-22 here, and we've got to be very careful. So we've got to have this inflation rate come down. All right, let's go over the top 3 asset classes on a long-term basis. Again, I know this sounds like a broken record, but nothing has changed. T-bills, US dollars, and utilities are still the top 3 asset classes, and so defense is still on the field, and it will probably remain this way for a while. All right, let's go over on the short-term basis, the bonds, okay? Again, we go over this every week so that we can give everyone a feel for the 2 major asset classes, bonds and equities. Well, as you can see, we've been out of bonds for pretty much most of the year, since January 3rd, and we started nibbling, and then we went right back out on August 29th, and rates have been going up, so the bond prices have been going down, and they still are going down this week, as we saw bonds even drop more this week. And the 10-year interest rates went from 1.55 to 3.88. They're still going up, right? So basically, you want to be in protect mode. You do not want to own bonds, at least at this point. All right, let's go over the equities, right? And again, I know we go over this every week, and there's a lot going on here, but we've been in protect mode again pretty much all year long. And then again, even though we tried to start nibbling here back to the end of the summer, we went right back to protect mode on August 30th, and we still are in that mode. And right now, we broke the June bottom, and now what we're trying to do is we're trying to form another bottom, and we're going to have some problems in the 38 to 3,900 on the S&P. If we can break through that, we may possibly get some positives and start nibbling again. But we've still got our work cut out of us on the equity side. All right, that's it for this week. Thank you again for joining us. Our next update is Monday, August 17th. And as always, please continue to subscribe, like, and comment. We do this again for your education. And thank you again. We'll see you next week. Bye-bye.